Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to corporate action reshaping markets. In today's show, Polymarket seeks a new raise that would bring the valuation to $20 billion, doubling its value in less than a year. And it could be the largest pharma deal ever, but investors are throwing cold water on it. Reports conflict over AstraZeneca exploring a purchase of Bristol Myers. We'll break that down. And in just moments from now, we'll be speaking with Jeff Smith, CEO of Starboard, who has several activist campaigns underway. First, let's get to some of the big deals that we are watching, and starting with a deal it feels like we're literally always watching. It's an update on the lawsuit against Paramount Skydance's acquisition of Warner Brothers. That trial set for March of 2027. CEO David Ellison spoke about it on the company's earnings call Tuesday.
We remain highly confident that this transaction will close, and we're preparing for basically a successful combination once it does. If you take a step back and just look at exactly where we are today, we received approvals from basically, 65 regulators representing 65 countries around the world, including the United States federal government, Canada, European Union, China, and many more.
Joining us on this is Bloomberg senior deals reporter Michelle Davis. I thought we were done talking about this deal at one point. It keeps coming back. So what's the latest? Now, has a lawyer set a date for this trial?
The
judge, that's who sets a date for trials.
The judge has set a date for the trial. It's going to be in early March of next year. It's not great for Paramount. They had been pushing for a much earlier trial date. They were hoping to get something by November. The states had pushed for April. So this is, a little earlier than what the states pushed for, but the judge was definitely sympathetic to the state's case. And what this essentially means is, Paramount and Warner Brothers are going to be in limbo now until this gets litigated, unless they can come to some sort of settlement out of court. We understand that Paramount CEO Ellison is open to some sort of settlement, but it's unclear whether the states are open to that. So worst case, Paramount's going to have to pay billions of dollars in ticking fees while this drags out.
So, Michelle, along with you covering media deals, you're also our specialist in pharma deals. And what a week this is with this deal floated between AstraZeneca and Bristol Myers, some conflicting reports. What are you hearing from your sources about how serious these conversations might have been and what it would actually mean to have the two of them merge?
So it is a tricky one because there have been some conflicting reports, including this morning, Reuters reporting that there are no current active talks between Bristol Myers and AstraZeneca. We reported Sunday that there had been some talks, however preliminary. Both companies are, of course, refusing to comment on the status of anything. But what's interesting about all of this is, after the news leaked Sunday, the investor reaction Monday wasn't great. Investors from both sides kind of threw up all over the deal. I mean, AZ shares were down 9%. BMS shares were basically flat. And normally when you see a company subject to, a potential takeover, their shares will move a lot more. And analysts really question the logic of something like this because AZ, its stock has a lot of promise. They have a lot of growth ahead of them. While BMS has been kind of thought of as like the sick man of the industry, their EPS is supposed to shrink over the coming years. And so there's just a lot of question about the logic here. That said, we do know that AZ has wanted to do something really big. And the fact that these talks were even happening speaks to kind of the mood in the market right now where like anything feels possible. We haven't seen a mega pharma deal like this for like a decade. So there could be more to come similar to this.
It's a great point. We're floating big airline deals. Why not big pharma deals? Michelle, thank you so much. That is our senior deals reporter, Michelle Davis. Now, in terms of other healthcare-ish deals, how about vitamins? P&G winning a bidding war for a $3.8 billion deal for supplement maker Thorne. Scarlett Fu has the details. Hey, Scar.
Hey, Danny, that's right. P&G is adding Thorne to its health and wellness offerings that currently include Metamucil, Align Probiotics, and New Chapter vitamins. Now, Thorne is a 40-plus-year-old company that was taken private in 2023 by L Catterton for $680 million. So this $3.8 billion transaction gives the PE firm an outsized return on its investment in under 3 years. This deal is expected to close later this year once regulators sign off on it. P&G rivals, including Unilever, were reportedly interested in acquiring Thorne for themselves as well as part of a larger wave of consumer companies extending their reach into health and wellness because of slowing growth in core businesses like detergent and diapers. Earlier this year, Unilever bought multivitamin company Grüns for $1.2 billion, while Kimberly-Clark is pushing through a $40 billion deal for Kenvue. Danny?
Scarlett, thank you very much for that. Elsewhere, Polymarket is in early talks with prospective investors to raise about $1 billion. People familiar with the matter telling Bloomberg that the raise would bring Polymarket's valuation to $20 billion. Todd Gillespie reports on banking here in New York and has been covering that story. I mean, they were just did a fundraise in April, right? Todd, why dip back into the markets?
Yeah, that's right, Danny. I mean, Polymarket, Kalshi, the two biggest prediction markets, have both been out there raising pretty much non-stop since inception, right? The fever around prediction markets, both from the regulatory side, the scrutiny that they're getting, from the users side, particularly with the World Cup that's boosted activity in recent months, and also now from the investors side, they're very, very interested, and particularly the hedge fund side, the exchanges who are looking to get in early on these projects. And in particular, one of the things we've reported, which hadn't been previously reported, is that their April raise closed with new investment from D.E. Shaw, which is a pretty big name in the hedge fund space, one of the earliest big quantitative investment funds, algo trading, started in the late 90s, and that firm has now gotten in on this game after big names like Jump Trading. Jane Street Cotu has also invested now in Kalshi as well. They were an early investor in Kalshi. Kalshi raised at a $22 billion valuation back in May. So now Polymarket, which was the early leader in this race against Kalshi, they've fallen behind. We've reported extensively on some turmoil operationally and legally for Polymarket in particular, and they're trying to really regain their footing right now.
I was going to say, I guess that doesn't deter investors from jumping in, right? Some of the regulatory concerns around Polymarket? I mean,
it would certainly be a worry.
Right.
The CFTC, we've reported the CFTC have launched a broad investigation into Polymarket, and particularly as well at some of their marketing materials after a Wall Street Journal report earlier this year said that they were basically pushing fake marketing materials, showing influencers who were winning bets that basically weren't real. Polymarket said they're doing a full audit and they're reviewing everything. And Polymarket has now also brought on a new chief growth officer, a guy called Travis van der Zanden, who was a former C-suite at Lyft and at Uber. He was a head of international growth for their drivers operation internationally. He's just relocated from Miami to New York to help basically reshape that marketing push that's come under scrutiny at Polymarket.
Okay, Todd, thank you very much for that story. Todd Gillespie reporting on Polymarket's big fundraise. Let's get to some other big deals that we're watching. Apollo reporting record revenue from fees. As advised to be one of Wall Street's largest lenders, Bloomberg's Laura Benitez has been following the story, and she joins us now. Laura, it really just feels that in this world of private capital giants, the big continue to just get bigger.
That's right, yeah, and this week was proof of that. So we saw Apollo report record fees from management fees, and a lot of that came from their capital solutions business, which is where they originate loans, and that's where we've seen some of the really big investment grade jumbo loans being originated in the last year or so, particularly even this year. There was a big Broadcom deal, which was $35 billion that Apollo led. That came from the capital solutions business. The revenue from that and those fees are definitely driving growth at the firm, and it's a core part of their business right now.
I mean, it's interesting to look at all the different giants and different businesses that are doing well. I spoke with both Carlyle and Brookfield this morning, for example, both of them reporting earnings, saying, look at the huge amount of fundraising we're doing. KKR also raising their biggest ever infrastructure fund. Laura, is there something to this? And I wonder just how much of the excitement is around AI strategies, and that's why these funds are able to raise so much money.
Absolutely. It's still very active. It's very real right now, which is something KKR said this week. My colleague, Alison McNeely, reported on this huge fundraise earlier this week. And it's so interesting because for all the worries and concerns that we're hearing and that are also very real, managers are able to go out and make these big deals and, raise huge amounts of capital for it. So I think while investors are digesting and asking questions, they're still willing to allocate. And I think the key is diversity as well. This fund has 3 different strategies. So I think, investors will be looking for a diverse portfolio as possible, something that kind of will hedge the risk from just pure AI infrastructure.
Laura, appreciate your time. Laura Benitez, fantastic reporting. Coming up, we talk about activist investing and navigating these markets with these very big bouts of volatility. Jeff Smith, CEO of activist hedge fund Starboard Value, and he'll discuss what he's seeing in the space. You're watching Bloomberg Deals. Starboard Value, with over $9 billion in assets, has launched activist campaigns in some of the world's largest companies. It's recently taken stakes in Weston, TripAdvisor, and CarMax. So pleased to say that Starboard CEO Jeff Smith joins me now to take a look at activism and the big picture from his perspective. Jeff, thank you so much for joining.
It's good to be here.
Great to have you here. And look, it's been about 2.5 months since your last position with Flowserve. What's it been like since? Any new campaigns, any new positions you have?
You know, the market has been really interesting this year. It's been more of a stock picker's market. I think you see it the last couple days. We've had stocks that have been moving on earnings both directions. So it makes it a great time for a value investor to be able to come in and buy positions at opportunistic prices and get involved and see if we can make a difference and improve those businesses and create value. So honestly, this has been a lot of fun this year.
So where have you found that value now? What's been an opportunity for you to jump into?
We have a new name that I'd like to talk about today.
Please.
So we've been active in restaurants throughout our career. So I think we're most known for Darden restaurants, but there's been others, Papa John's, Bloomin', some other restaurant chains. And we're invested in another restaurant. So we're in Shake Shack, which we are very, very excited about.
So how significant is your position?
We're economically one of the larger shareholders, maybe the largest active shareholder. It's several $100 million. And you know, we're really excited. It's just too cheap. So this is an example of this year of a stock that's dislocating maybe more than it should. And in this instance, after the first quarter earnings, the stock came down from roughly 90 to 55, 60. And when you look at the quality of this business, how great a business it is, how much it's growing, how many new stores can open, it's just too cheap. So if you looked at a whole swath of restaurant companies and you kind of measured how fast are they growing compared to where their EBITDA multiple is, and you drew a line, you should be getting a relationship between growth and multiple. The faster growing ones should have higher multiples, the slower ones, lower multiples, just like any other industry. And Shake Shack just doesn't make sense. So we're able to own Shake Shack at roughly 10 times EBITDA, and the multiples should be twice that, given that it's growing mid-teens. And it's, you know, one of the fastest growers, and you know, high quality brand, high quality restaurant.
Well, to your point, you and the team at Starboard are legendary for what you've done in the restaurant space. Darden coming in, sweeping the board. I don't think anyone will ever forget your report on Olive Garden and lack of salting the pasta water. You mentioned Papa John's, and here you're making big operational changes for those restaurants. So you're an expert in this. So when you look at Shake Shack, are there operational changes that you think that they should be making and that you would push to make?
Well, you know, this one is even more interesting and maybe slightly easier. So I don't think there are massive operational changes. It's actually run, well, look, Danny Meyer's legendary as the founder, and the CEO is Rob Lynch. And Rob was the CEO that we hired at Papa John's to run Papa John's when I was the chair of Papa John's. So I know Rob well, he's a terrific operator. Shake Shack is running really, really well. And in fact, he's done a great job of lowering the cost to build a new Shake Shack. And the importance of that is then the returns on new restaurants go up. So if you can have among the best returns on a new restaurant build, it makes it easier to justify building more and more restaurants, whether you do it yourself or you have a franchisee do it. So the opportunity here isn't so much operationally. We think they do a great job there. The opportunity is to continue their mid-teens growth and accelerate it even further. They have about 400 restaurants, owned restaurants in the US. They have a target of 1,500. We actually think it could be 2,500, but they have a target of 1,500. But they've limited themselves into doing in the US only owned restaurants. And they haven't been willing to franchise, even though they franchise internationally, and they franchise actually non-traditionally in airports and in stadiums. But in the US, they've chosen from way back when that they want to own the economics and they want to control the outcome. But they've proven that they can have independent operators operate their restaurants by doing it internationally and in non-traditional areas. So we would like them to layer on franchising in the US in addition to growing their own stores. And if they do that, we think it can make a material difference in their growth rate, and they can get to their 1,500 store target in 7 years instead of 12 years if you model it out. A big, big difference, which creates a lot of value. Again, modeling growth rate and multiple, we think they're valued at half of where they should be, but if you can move the growth rate even higher, then you get even more opportunity.
Right, and some of their peers, and I'm assuming ones that are, to your point, trading at a higher multiple than Shake Shack is, the franchise model is well tested. Why do you think Shake Shack hasn't already gone there? And do you think it's something that they're a little bit resistant to? Or do you think that it's something that they'll easily take on board?
I think it's a good discussion. So they aren't resistant to it because, again, they've done it internationally. I think if you were to go back historically, based on the conversations I've had with them, early on, they had a discussion about whether they should grow through franchising or they should own their own restaurants. And they decided very, very early on that they wanted to own their restaurants to control the quality. This is a high quality brand. They cook everything to order. It's real food. This is a good quality business. And they wanted to control that image and they wanted to control the quality. Great decision. They've done an amazing job with that. Terrific decision. Fast forward to where we are now, we've proven that we can build 400 restaurants. They're actually growing the number of restaurants they can build by themselves. They're doing 65 this year. Last year they did 40 something. And they've proven that independent operators actually can cook their food to their standards internationally as well as in non-traditional restaurants. So they've already done that. As it relates to why they're not willing to do that in the US as of yet, I think it's just a matter of time. I think it's a good conversation to have. I think they just need to figure out how to be able to do both. Take the areas that you want to densify and you want to own, and let's own those. And the areas you weren't going to get to on your roadmap for 4, 5, 6, 7, 8, 9 years, let's just do that at the same time. Let's bring in quality franchisees and have them attack those markets that you weren't going to get to for 7, 8 years anyway, and let's get those started sooner so we can improve the growth rate. And if you just run the math, it's a higher NPV, it's a higher return for shareholders. So it's a good discussion.
Okay, so some of your other stakes, again, you know this industry very well. Lamb Weston was a recent one, which makes fries for McDonald's and maybe soon Shake Shack if they're not already. How have conversations been going there? You've talked about them reducing costs, drive growth beyond just raising prices. Have things been productive since taking your activist campaign with them? Yeah,
Lamb Weston, French fries. Didn't mean to talk about both of those today, but yes, they are related. Lamb Weston, we believe, does supply some to Shake Shack. They're not a sole supplier. The premier or one of the premier French fry companies. It's a business that has a moat around it. There's only so many players that can make French fries, so it's a beautiful thing. When we made our investment, they had come on some harder times where they had expanded too quickly and they had some supply issues and they were kind of in the penalty box. And what's happened since then is we've gotten involved and they've elevated their CEO. They brought on a new exec chair who we're really excited about. And they've been executing better. So the stock's performed a little bit better. They've gotten their volumes back. They're starting to raise their price. Earnings have stabilized. And we've had conversations with them just recently about how we have to improve the earnings growth trajectory to be able to get sustainable earnings growth out of the business. But we're super excited about what's ahead for Lamb Weston, and the relationship has been terrific.
So you sound confident that things are moving in the right direction. Would you say the same with CarMax? They've also made board changes after your involvement, too.
Yeah, CarMax, I think we talked a lot about CarMax last time. Yeah, CarMax.
So we need an update for everyone watching.
CarMax is a lot of fun. We were able to buy into CarMax, I think I said the last time I was here, near book value, which didn't make any sense to me. And in hindsight, that seems like it made sense because the stock has worked. And a really cheap multiple of earnings and cash flow. What they needed to do is to be able to get their share back and be able to do that by getting their price to consumers down while being able to hold their gross profit. And they were running their business kind of backwards before, where they were running it based on gross profit. So the way they were running it before was they would buy cars, they would spend the money to refurbish them, and then they would add, call it $2,000 on top of the cost and sell the car there. Problem was they were inefficient on buying and they were inefficient on refurbishment, which meant that when you added $2,000 to the price of that car, their market price was too high. So how do you get that market price down to the right level so that you can get your share back and gain share, but keep your margin? And the way you do that is you have to get more efficient in buying cars and in refurbishing cars. They brought in a great new CEO, Keith Barr, who's honestly been getting up to speed way faster than I would have expected, and we're pretty excited about it. They brought on some new board members, including some that we recommended, and they are starting to hit their stride. We're very, very excited about what's happening. Some of the, some of the data we've been looking at looks really good. I think they should be able to gain momentum. I still don't understand why their omni-channel business shouldn't be better than Carvana's omni-channel business, because they have all these lots in addition to being able to buy and sell cars digitally. And when I think about a used car, I would think, if I were a consumer, I would think that if I wanted to buy a car, I might want to see it, I might want to touch it, right. I might want to smell it. So having that optionality that you don't really have to pay for because the stock's so cheap makes it a great investment.
Again, this is the common theme between all of these, and this is kind of where we started, Jeff, that a lot of these opportunities have been really cheap, but it's also not just a market where things are discounted. It's a market that is really volatile, and we've seen huge swings in this market too, whether it be because they report earnings or whether because Jeff Smith announces a new position. How does that change your investment thesis, where things aren't just cheap, but they're jumping around a lot?
Love it. Love it. Stay disciplined. It's what we do as value investors, plus a catalyst as an activist. This is what we want. We want stock-specific volatility, and what we will do is when it gets really opportunistic, we're going to buy it. And if it gets even more opportunistic, we're going to buy more of it, and then we'll start making a case for change to be a catalyst. And then as the stock moves higher, we're going to continue to evaluate how it's valued versus their peers and their potential and what can happen. Where's the earnings power? Where are we going? And then, just like any other good investor, you might sell some, you might buy some again. But that volatility, if you can capture it and remain disciplined,
right,
is a great thing for an activist, for an active investor, yes, and an activist investor.
Hey,
yes.
Jeff, that's all we have time for. Thank you so much for joining. Jeff Smith, Starboard CEO, and of course we will be out to Shake Shack as well to get comment after Jeff's involvement. You are watching Bloomberg Deals. You are watching Bloomberg Deals with Danny Berger and Scarlett Fu. Up next, global VC and private equity funding reached $463 billion in the first half, driven by AI mega rounds. We'll dive into the details with our IC coming up next. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go to Scarlett Fu, who's taking a closer look at how the AI frenzy has helped split VC into the winners and have-nots. Scar.
That's right, Danny. Fundraising by VC firms has fallen sharply since the pandemic peaked to $101 billion this year from almost $416 billion back in 2022. Higher interest rates deflated startup valuations and shut the IPO window. That made it harder for VCs to exit investments and return money to shareholders, which then slowed down fundraising across the industry. And now, investors want access to venture firms with early stakes in top-tier AI companies. So, money flows disproportionately to firms like Founders Fund and Andreessen Horowitz, while smaller, sector-focused funds struggle to raise funds. Performance, that's also becoming more uneven. There's a widening gap between the top 10% of 2024 vintage funds. They're up about 49%, while the bottom quartile is down 17%. So a distinct K-shape is forming there. Danny?
Hey, Scarlett, thank you very much. And that brings us to this week's Alternative View. And we're going to take us into boardroom debates in real time. Joining us now is Emily Zhao, Managing Director at Salesforce Ventures, Daniel Doctor, Managing Director at Dell Technologies Capital, and Julia Moore, Co-founder and Managing Partner at Breakout Ventures. Great to have you all on today. And I'd love to know what you're looking at. And presumably, I think we can all just say we're kind of operating in the AI universe here when it comes to venture capital. But I would love to know what part of the ecosystem you think is most appealing. Emily, why don't you kick us off?
Yeah, for sure. Thanks, Danny. I think over the last 3 to 4 years, we've been very actively investing at the infrastructure layer of the AI wave, including companies like Anthropic, Together AI, Crusoe, 11 Labs, Runway, and many more. I think looking forward, what we're most excited about is bringing AI into the physical world, which is actually a lot harder than bringing AI into the digital world with a lot more friction. That's why we're excited to be investing in robotics in companies like Mind Robotics and Physical Intelligence.
Julia, let me bring you into the conversation because I have a feeling you might think something similar. Is the next wave for you and the most attractive opportunity also in the physical space for AI?
Yeah, so we're an early stage investment firm and we focus on the frontier of science and technology. So the physical world is cells, biology, chemistry, a little bit different, including sort of robotics. And so when we think about we've watched this massive AI infrastructure play out over the last couple of years, and that next wave goes to whoever has proprietary data and a durable moat. So the sectors that we operate in, typically life sciences and industrial technologies, those are sectors that generate massive proprietary data. They sit in regulated markets with high switching costs, and they're full of inefficiencies that are still waiting to be mined.
Daniel, what are you looking at?
Well, thank you very much for having me on today. Dell Technologies is an early stage venture capital fund. So we do seed and Series A, and we're very enterprise focused. So cybersecurity, AI, developer tools, everything in the data, and of course, the world of AI today. Within AI, there's a couple of areas that are getting a lot of attention, in part because there's huge amounts of dollars flowing into them. That was mentioned by Emily, which is the inference and the compute infrastructure to provide inference and training, shifting from training, looking back to inference going forward. And of course, the other really big area is reinforcement learning, which is the whole category of using data to help all of the models improve and get smarter and smarter.
Daniel, let's talk about some of the risks, because I want to pick off of what you said. What is the risk to that universe, though, that the large LLMs just kind of do it themselves? Why would an independent startup really be able to do something like that better than these large established companies?
Well, there's a couple of risks in terms of investing in the space right now. So, it feels like, we are in a massive wave. So everything is being priced to perfection or priced as if everything is going to be the ultimate winner. There can only be a few ultimate winners. The power law still exists. It always has existed in venture capital and, frankly, most industries. And so I think the big risk is there will be a few winners, and there'll be many companies that are not able to get to the finish line. But there's really great opportunities to do things in and around the large model companies, and a lot of the things that we were talking about. The large model companies are, in fact, the largest customers of most of these companies.
Right. Emily, what do you think about this idea that everything is priced to perfection? Is there enough differentiation in valuations across the AI universe?
Yeah, I think historically speaking, valuations have always been relatively high for the best companies in the startup space. Those companies command a premium on the valuation front, and they may be slightly ahead in terms of their commercial traction, or slightly ahead in terms of valuation compared to their commercial traction. But I think what we do as Salesforce Ventures is very much betting on the founders with the vision of generational outcomes. So paying up for that, the best outcomes is worth it. And we still have the same level of rigor when it comes to looking at the type of investments we're making in the AI space. And that's the best founder quality, the size of the market opportunity, and an attractive return profile.
Julia, how do you see this debate over valuation shaking out?
I think the valuation piece is hard, because if something is already successful and it's priced in, is that really venture in its traditional sense? If we think about what is core to the venture role, is really that first principles thinking, underwriting what is contrarian today but massive tomorrow, and how much time do you have to price something before it's obvious or inevitable is really the question. And we, as early stage investors, are trying to get in early, and it really requires us to come with a prepared mind about what is contrarian now but massive later. In our space, obviously we've been talking about the physical world a little bit, bringing that same AI playbook that worked for language, but this time, for example, there's no internet to train on. We don't even know the mechanism, let alone have it captured in a tidy data set when you're talking about biology and chemistry. And I think that's an example of where you can have still a contrarian view early.
That's interesting, Julia. Does that mean that some of this industry maybe has lost its way and is kind of just following the pack when it comes to AI investing?
I'm going to have a specific angle on the world of AI because we work so much in the physical world and with cells and biology. Right. I think what maybe is worth noting is a little bit of that prepared mind conviction early of where space is going versus what you might see in later stage rounds right now. Something I've noticed, and I've been in the space and investing for the last 20 years, and you do notice a lot more of a momentum play as you get into the mid and later stage rounds, where it is you have a little bit of a harder time early stage, where if a generalist investor hasn't built their conviction yet, the space is actually moving faster than they can do work.
Yes.
That they kind of wait for the signal, and that signal's already priced in by the time we get to those rounds.
Emily, can I also get your take on that idea of the momentum following of the industry?
I think I disagree with Julia slightly because we do invest at a later stage, and I do think the pace of deal making has dramatically increased over the last 3 to 4 years because the tremendous tailwinds in AI are allowing startups to achieve their product and commercial milestones a lot faster than the previous generation of startups. So that means that historically, even though we might be investing at a later stage from a timing perspective, it feels much earlier. So I agree with Julia in terms of having the prepared mind. We're constantly looking at what's the next frontier, what's the next thematic area we should be looking at. And because we're investing at the later stage, there's a lot more customer work that we can be doing. We can talk to customers of these startups to get the right feedback. And I think our secret sauce is also Salesforce Ventures has our own very large customer base we can tap into to help pressure test that product.
Hey, Daniel, I have 30 seconds, so I hate to do this to you, but where are you on this debate of momentum following
I think you're touching on a really important topic, which is the amount of time that venture capital investors have to get conviction about an investment and a founder, especially us early stage investors that do seed, is compressed dramatically, just like the time to grow an AI company and get to scale has compressed dramatically. So you really have to leverage, we leverage our expert networks and we leverage our relationships with Dell to help us get conviction, build conviction about early stage founders as fast as possible.
Hey.
Otherwise,
Thank you all so much for joining. Not enough time, but a pleasure to have you all on. Emily Zhao at Salesforce Ventures, Daniel Doctor at Dell Technology Capital, and Julia Moore at Breakout Ventures. Just want to give you a quick check on Shake Shack prices in case you missed it. We were just speaking with Starboard CEO Jeff Smith in the past couple moments, announcing a new stake in the fast food company. He says that he is likely the largest active holder of Shake Shack, at least the largest activist holder of Shake Shack at the moment, saying that the position is several $100 million. He says that a big part of his thesis is just that Shake Shack is trading very cheaply, but also pushing them to adopt more franchise models in order to grow. Again, this is a space that Starboard knows very well, having done legendary campaigns on Darden and the like. Again, we'll keep an eye on these shares, at one point trading up 11%, now up about 10.33%. Again, one of the many reasons why this deal show is a must-watch. Up next, the mega deals pipeline has been robust this year, pushing activity to near record levels. We're going to speak with Kimberly Petillo-Décossard, who will speak to the current uptick that she is seeing. You are watching Bloomberg Deals. You're watching Bloomberg Deals. I'm Danny Berger. 2026 is shaping up to be the year of the mega deal. SpaceX acquires xAI, Paramount making a bid for Warner Brothers Discovery, Devon, Coterra, McCormick buys Unilever's food business, just to name a few. And earlier this hour, we are also discussing the potential for the biggest pharma deal ever with AstraZeneca and Bristol Myers. So for today's premium player, we wanted to hear from someone who advises public and private companies and their boards on complex M&A, because complex it has been. Kimberly Petillo-Décossard, global co-head of M&A at White & Case, joins us now. Kimberly, great to see you.
Lovely to be here. Thanks so much.
And this is the thing, that deal volume has really been picking up, but how uneven is it? Is it really concentrated in those top mega deals that we've seen this year?
Yeah, for sure, Danny. So if you look at the year-over-year numbers, the mega deals, 10 billion or plus, is the name of the game. Everyone is chasing scale, and we're seeing the U.S. be the dominant player in the market and strategics being the dominant player amongst strategics and private equity.
What's driving that? Is it regulatory? Is it something else? Just cheap stocks and too good of an opportunity?
No, it's opportunity cost, actually. So strategics are really chasing scale at the moment, and they see the cost of waiting as far greater than the cost of potentially overpaying for assets that can fuel their transformations.
What is the cost of waiting then? What are they trying to avoid dripping or falling off into?
If you look at where the sectors are aligning, the two biggest sectors so far this year have been tech and energy. And those are what's really driving. People are chasing AI. They're chasing this digital and AI transformational revolution. And AI needs power, and power at scale, which brings together the intersection of energy, tech, and infrastructure.
Has the regulatory environment been aiding to it? Because I remember I've been speaking to someone, and one of the reasons they said it was happening so quickly was get your deal done now. You don't know what Congress will look like after the midterms. And for the moment, it's a White House administration that is more friendly to some of these larger scale deals.
Deals are definitely getting done. The regulatory environment at the federal level is certainly favorable for a lot of these larger transactions. However, I wouldn't say that the regulatory environment is predictable. I would say actually it's a bit unpredictable, particularly when you have states that are very, very active. And when you look at most deals have some global component to it, the global regulatory environment is also a bit unpredictable.
Well, on the global M&A environment, this is something that you mentioned in your work, that it's very much so U.S. firms are looking out to international deals. To what degree is it just the U.S. buying things abroad versus other companies abroad coming into the U.S. and looking for deals to do?
We're seeing both. I think there is definitely more inbound activity than outbound activity, but U.S. players are definitely going abroad right now, and they're doing it at scale. If you look at the deal values of outbound deals, it is much larger than it has been historically, but that deal count is low. What that tells us is that they are taking the opportunity to make strategic bets that fulfill their thesis.
What about this market volatility? What does that do to deal making when you can have huge swings in stocks, where you can see entire sectors sell off into a bear market and then rapidly bounce back? For public company M&A, how does that change the game?
I spend a lot of time in boardrooms, and it is the conversation we're having constantly. Volatility favors the prepared, though. And for boards that are thinking about deals all the time, who have a clear thesis, who have their financing relationships lined up, who have their target lists ready, those are the ones who can move very, very quickly in a very unsettled market. But boards are not saying, should we do this $10 billion deal? It's how do we do this $10 billion deal in a market that changes every 3 days, 3 months.
So it's been busy thus far. How's the pipeline looking, Kimberly? How busy are you going to be for the rest of the year?
The pipeline is very busy. I think that this is not a blip. I think that we're going to see sustained deal activity. I think this market is very different than the robust M&A market that we saw a few years back. I think this one is sustainable because all of the players are being very disciplined. I think what we saw in 20 and 21 was a bit undisciplined, but we're seeing people take much longer on diligence, but still in an accelerated way so that they can move quickly in the market.
Kimberly, thank you so much for joining. This has been so interesting.
Lovely to see you.
A pleasure to have you. Kimberly Petillo-Décossard, Global Co-Head of M&A at White & Case. And in case you missed it, just want to point out Shake Shack still surging this morning, up 12% after Starboard CEO Jeff Smith told us that he has taken a position. Up next, we'll talk more about activism. This is Bloomberg Deals. This is Bloomberg Deals. I'm Danny Berger with Scarlett Fu. DGB Investments founder Douglas Bergeron has built a stake in furniture company Ethan Allen, which has seen shares fall about 7% year to date. Bergeron is pushing to replace the company's entire board of directors by nominating himself and former executives at eBay, Wayfair, and Neiman Marcus. Joining us now is Douglas Bergeron, founder of DGB Investments and former Verifone CEO. Thank you so much for joining.
Thank you for having me.
So I was looking through your open letter to shareholders, and you called Ethan Allen a melting ice cube. But we did hear from them last week. They reported a large cash pile, positive net income, another regular dividend. So what is it about this company when you look at it that you say this could be on the verge of disappearing?
Yeah, it sounds like a tobacco company, really, with a large dividend and declining sales. Eventually, you can't allow sales to decline every year for 20 years because you'll eat into your fixed cost and you'll get negative operating leverage. So the business is fundamentally very strong. The products are great. Farouk is correct. The domestic manufacturing is a huge advantage for the business in a tariff world. But there's been no attention paid to sales and marketing, and especially digital. And although the company has continued for every year that I've been following it, to pay lip service to the fact that they will be doing it, but nothing happens. Sales keep on coming down.
I know their whole pitch is we're kind of more interior decorators. Like, that's our model. We'll go out. We're not the same fancy showroom that you might see in an RH. What would you say to that argument from them, that this is their DNA and this is how they operate? So to change their showrooms or try to push e-commerce more than they already are kind of changes the DNA of Ethan Allen.
I mean, a digital footprint is not an option. I mean, they actually disclose in their 10K that they view the internet as a threat, which is hilarious. That's something out of 2002, not 2026. And it's not just buying Google AdWords. You have to have a digital presence with each consumer that they think about you when they're about to buy something, where you're engaged with them on a continuous basis. They have missed the boat completely on that.
So you aren't asking for 2 or 3 board seats to collaborate. You're kind of going the nuclear option. Right. Get a whole new board in. Well, why go that route?
Listen, we've had some discussions with the company. It's very clear that they were dismissive. The last thing I want to do is transform myself from a frustrated shareholder to a frustrated single director on a board. Farouk Kathwari deserves a lot of credit for the company that he's been running for 38 years, but he's 82 years old. The board is average age is in their 70s. They need a fresh, clean start. If you look at my director nominees, it's an amazing group. Any one of these people would be loved at that company's board. So yes, we're asking for a whole clean slate.
So sorry, just to be clear, does that include a new CEO as well, do you think?
Yeah, we're going to have to run a search. Maybe we'll run it earlier than later. Even the press we're getting with the proxy campaign will, I think, allow us to go out and find a very, very compelling CEO that can help transform this business with the mentorship of some of the biggest retail names out there.
And say you described the pushback that you're getting from that company. How do you think the wider shareholder base will feel about this?
I think they're speaking today already with their share purchases. I think they're frustrated. Listen, they pay a dividend. That's good. We're not challenging that as a notion, but there's wasteful spending in the company. They own a hotel. What's a furniture company doing owning a hotel? And if you own a hotel, you probably are doing a whole bunch of other silly things. So we want to reallocate capital from the business operations to a much fresher digital marketing front office presence. And that may include refreshing a lot of the stores, et cetera.
Douglas, to what degree, though, is this an industry that's just challenged? I mean, Ethan Allen itself has pointed to macro headwinds, a slower housing market, higher interest rates. Is that something that just, regardless of what you change, and quickly about 45 seconds here,
if you read the letter, in 2006, Ethan Allen was doing $1 billion a year in sales. RH, the Restoration Hardware, they're now RH, was doing $700 million, and Williams-Sonoma was doing about $1.5 million or $1.5 billion in 2. Today, 20 years later, Williams-Sonoma is doing $8 billion, RH is doing $3 billion, and Ethan Allen has shrunk to now under $600 million. So there's no argument that the industry is stale. Yes, the industry does do better in better housing markets, but Farouk has managed to lose market share in good markets, good housing markets, and in bad housing markets.
Right. All right, Douglas, we're going to have to end it there. And to your point, shares are bouncing after you announced your stake, so getting a warm reception there. Douglas Bergeron, founder of DGB Investments. We're seeing Ethan Allen bounce, so is Shake Shack after that stake from Jeff Smith. And that about does it for Bloomberg Deals. Stay up to speed. Subscribe to the Bloomberg Deals newsletter. This is Bloomberg.